Hello everyone, and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. This disclaimer: True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified Elliott Wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott Wave theory. In addition to my work as an analyst, I am also an author and educator. I wrote Introduction to Elliott Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. I'm going to discuss about gross domestic product, also known as GDP, and then we will also discuss the main financing rate related to Europe. So these are the important financial news events last week. Okay, so let's start with the first one, gross domestic product. Q over Q means quarterly over quarterly related to New Zealand, and the currency pair I'm going to focus is the New Zealand dollar versus United States dollar currency pair. Date and time is written over here. It's December 17th. So today is December 23rd. Okay, so this is the previous week preview. So December 17th at 9:45 p.m. UTC time, we got this news. Now, what is gross domestic product, also known as GDP? Gross domestic product measured the change in the total value of goods and services produced in New Zealand compared to the previous quarter. It was one of the most important indicators of economic health and overall growth momentum. A higher than expected GDP reading normally signaled stronger economic activity. This typically supported the New Zealand dollar and could lead to an appreciation against the United States dollar. A weaker or negative GDP figure usually suggested slower growth and often pressured the New Zealand dollar. Because GDP reflected the overall performance of the economy, Forex traders watched this release closely. It had the potential to create short term volatility and influence expectations for future monetary policy decisions by the Reserve Bank of New Zealand. Now, the number that we got previously was minus 1.0, forecast was 0.9%, and the actual number we got is a positive number, which is 1.1%. The New Zealand economy had faced several challenges in recent quarters. This included soft domestic demand, tight lending conditions, and cautious business investment. The previous GDP contraction highlighted the economic slowdown and raised financial concerns about growth momentum. Market participants had expected a rebound to 0.9%. This release was important because it helped confirm whether the economy was stabilizing or still fragile. The GDP data was also closely linked to expectations for future Reserve Bank of New Zealand policy decisions. Any surprise could influence interest rate outlooks and directly impact New Zealand dollar price action. Now, leading into the release, economic signals were missed. Consumer spending had shown mild improvement but remained cautious. Exports continued to support growth but faced global uncertainty in New Zealand. Construction and services showed gradual recovery. Inflation pressures were easing but still monitored closely. Based on these conditions, financial analysts had outlined three different scenarios. A higher than expected, meaning above than 0.1% number. If we get that number, that would indicate stronger economic recovery. It would suggest improving demand and sector activity, normally bullish for the New Zealand dollar. NZD was expected to move higher. Now, if you take a look at a price chart of New Zealand dollar, this is the NZD USD currency pair. So last week we discussed that market is probably going to drop, and we got the drop. Now, as of today, it's trying to rise back up over here. So on December 17th, we actually got a drop in market after the news release. Okay. And we got the number which is 1.1% number. Okay. So despite getting 1.1% number, which was above both the forecast and previous reading, on paper, this was a strong positive surprise for the New Zealand economy. However, despite the better than expected financial data, NZD USD currency moved lower after this news release. And this reaction suggested that the positive GDP was already priced in. Forex traders focused on profit taking after the initial move. Broader US dollar strength weighed on the pair. Market participants may have questioned the sustainability of growth. Expectations for Reserve Bank of New Zealand policy remained cautious. This was a classic example of buy the rumor, sell the fact price behavior. That's what we got inside NZD USD currency pair. So volatility got increased. We got spikes on the both side. You can see the tail of this candlestick over here on the both side, but then overall market dropped lower. Okay. So initial reaction was, quickly reverse market tries to rise up, and then we got overall drop in market. The New Zealand GDP release was a high impact event for NZD USD currency pair. Although the actual figure came in stronger than expected at 1.1%, the market reaction was bearish. The the move reminded forex traders that strong data does not always lead to bullish price action. Forex market expectations, positioning, and broader currency flows often matter more than the headline number. The next one is the main refinancing rate in Europe, and we are going to discuss the euro dollar currency pair. Now, what is main refinancing rate? The main refinancing rate is the key interest rate set by the European Central Bank (ECB), determining the cost at which banks can borrow funds from the ECB. A higher than expected rate or a hawkish outlook generally strengthens the euro as it signals tighter monetary policy and higher yields, often pushing the euro dollar currency pair higher. Conversely, a rate cut or dovish guidance suggests economic support and lower returns, which can weaken the euro and pressure euro USD lower. Forex traders monitor this release closely due to its strong impact on euro sentiment, interest rate expectations, and short term volatility in the pair. So, because of its strong influence on interest rate expectations, most people usually watch this important financial news event. Now, the previous number was 2.15%. That was the interest rate number. Forecast was 2.15%, and the actual number we got is also 2.15%. Now, if we take a look at a price chart of euro dollar currency pair, let me go over to the euro USD and go over to December 18th. Over here, you can see Euro USD first tried to rally back up, and then we got overall drop in price action of euro dollar currency pair. That was the price action we got in euro dollar. The eurozone economy had shown mixed performance in recent months. Inflation pressures had started to ease, while growth indicators from manufacturing and services pointed to slowing momentum. The ECB decision was closely watched, even though no rate change was expected. Traders focused on whether the central bank would maintain a firm stance or shift toward a more cautious tone. Market expectations were already priced in, which increased the importance of the ECB's communication and forward guidance. Now, the analysts basically outline that if we do get a rate cut, that would signal concern about slowing growth. It would reduce yields expectations, bearish for the euro, and euro USD would likely decline. Well, what we got is we got a same number. The number is 2.15%, so it's unchanged. And market was trying to uh, market was trying to rise up first, then we got the drop. Let me show you the chart again. So this is the euro dollar currency pair over here. Okay, so right over here we got a rally first, then we got a drop in price action. And now as of today, euro dollar is trying to rise back up over here even further. So the ECB kept the main financing rate unchanged at 2.15%, fully in line with the expectation. The expectation or the forecast was 2.15%. Despite the neutral rate decision, Euro USD moved lower after the release. The downside move suggested that the decision was fully priced in. ECB guidance was interpreted as cautious rather than hawkish. Markets focused on slowing economic growth risk. Forex traders reduced long euro positions. Broader US dollar strength added pressure. And that was the main reason that we got the drop inside euro dollar currency pair right over here. Okay, here's the daily chart again. And this is the euro dollar December 18th price action. So the price action reflected a sell the fact reaction even without a formal policy change. So volatility increased immediately after the announcement. Initial move favored the downside. Technical levels played a stronger role than the headline rate. This even highlighted the importance of ECB tone and forward guidance. Market positioning before the release, US dollar strength, and broader risk sentiment. Technical confirmation also, after the news. So the ECB main refinancing rate decision on December 18, 2025 was a high impact event for euro dollar currency pair. Although the rate remained unchanged, at 2.15%, the euro USD currency pair showed a move to the downside. This outcome reinforced an important lesson for forex traders. Price action reacts to expectations and guidance, not just the headline number. Understanding market positioning and central bank tone is essential for trading major news events effectively. Now, let us take a look at previous week global market trends. I'm going to discuss the euro dollar and US dollar Swiss franc currency pair. So let's take a look at euro dollar currency pair first. As far as the euro dollar is concerned, we got this bullish breakout over here, and the euro USD is probably going to rise up over here. Next, let us take a look at daily time frame. So daily time frame, we got this break to the downside, then break to the upside, then a retest of this downward sloping trend channel where I draw this green color arrow. So after that, market rallied up. Now we do have some resistance up there. Uh, if we go back to the daily chart, so let's try to draw a resistance. So this is the resistance level right up over here, which market might tries to test. We also have another one over here. So market might tries to test this resistance level and then tries to drop back lower. Obviously, if we get a bullish breakout above this level, then it's going to rise up even further. Okay. Next one is the US dollar. Swiss franc currency pair price action is going down, and we got this bullish breakout, then a retest. Market tried to rise back up over here, but so far no success. So the way I see US dollar Swiss franc is probably trying to move down over here, and this was the expectation. This is what I've told you guys last week as well, that US Swiss franc is probably going to drop. So we got this decline. Now we might get one last bullish push to the upside, and then market is going to even drop further in US dollar Swiss franc currency pair. This one looks also possible. Regarding the US dollar Swiss franc, if you check out the 4-hour time frame, this was the trading range, and price action actually managed to break the lower support line. So we got a pullback and then a further drop in price action. So right now price action is testing these old swing lows over here. So it's possible that we might get a reaction to the upside and then further weakness in price action. But the overall trend is still down. It's a downtrend, bearish trend in US dollar Swiss franc currency pair. Now, let me talk about current week macroeconomic events and data releases, and I will be covering the key developments in Forex market with a focus on fundamental analysis. So first one is the what we have. Well, gross domestic product GDP Q over Q is quarterly related to New Zealand. Then we have no, that's the okay. Go over here. That's the one we are going to discuss. The gross domestic product related to Canada, and we're going to focus on US dollar CAD currency pair. Now, what is gross domestic product in Canada? Gross domestic product MORM stands for month over month, measures the monthly change in the total value of goods and services produced in Canada compared to the previous month. A stronger than expected reading supports the CAD and often pressures USD-CAD lower, while a weaker or negative figure can weigh on the CAD and push USD-CAD higher, making this release important for short-term market volatility. Because GDP, directly influences Bank of Canada policy expectations, this release frequently triggers sharp short-term volatility in USD-CAD currency pair. Now, the previous number we got was the 0.2%. That's the GDP number. And the forecast is actually minus 0.3% number. Actual data not yet released. It is going to be released later today. Now, Canada's economy has been facing headwinds from slowing domestic demand, tighter financial conditions, softening consumer spending, pressure in interest rate sensitive sectors. The previous GDP reading was 0.2%, and it showed modest expansion. However, the current forecast of minus 0.3%, that's a negative number, signals expectations of a monthly contraction, suggesting the economy may be losing momentum. So Forex market is closely watching this financial data release because continued weakness would reinforce expectations of future Bank of Canada easing, while any surprise to the upside could quickly shift sentiment. So the recent economic indicators in Canada suggest cooling manufacturing and services activity, moderate weakness in exports, reduced business investment, and persistent inflation pressure limiting policy flexibility. With GDP expected to contract, forex traders are positioned cautiously, anticipating the CAD softness. However, GDP releases are prone to surprises, and deviations from forecasts often result in strong intraday price action. Now, let's say we get a better than expected GDP number, meaning instead of getting a minus 0.3% number, we get a positive number. That signals economic resilience and reduces pressure on Bank of Canada to ease policy. And that's bullish for CAD, meaning USD CAD likely moves lower. Now, if you take a look at a price chart of USD CAD currency pair, it's already going down. So that's a bearish drop we got in USD CAD currency pair, and the way I see it's probably going to drop even further, even after the news release. Now the news is obviously going to release after uh, an hour almost, so we will see how the market is going to react, but the overall trend is down. This is the breakdown of this bullish trend channel over here. So the trend is already down in USD CAD currency pair. Now if we get a number worse than expected GDP, meaning we get a number which is below than minus 0.3%. That indicates deeper economic contraction and strengthens dovish Bank of Canada expectations, and that's bearish for CAD, and USD CAD likely move to the upside. I would say if we do get such a number, it's just going to be a pullback, and that would provide us actually a solid trading opportunity to join the downtrend. So the forecasted minus 0.3% GDP reading suggests Canada's economy may be entering a softer growth phase. If confirmed, it would reinforce CAD weakness and support USD CAD upside. However, any upside surprise could quickly reverse sentiment and strengthen CAD. This release is especially important because GDP shapes expectations for future Bank of Canada policy decisions. So the final key takeaway is Canada's GDP month-over-month release has the potential to create strong volatility in USD CAD currency pair. A weaker than expected result favors USD CAD upside, while a stronger reading would support CAD and pressure the pair lower. Forex traders should prepare for rapid price movement and closely watch how the actual figure compares with the minus 0.3% forecast. Next one is the unemployment rate in Japan, and we're going to get that on December 25th at 11:30 p.m. UTC time. The currency pair we're going to focus is the US dollar versus Japanese yen currency pair. Now, let me talk about it. What is the unemployment rate? The unemployment rate measures the percentage of Japan's labor force that is unemployed and actively seeking work. It is a core indicator of labor market health and provides insight into economic stability, consumer confidence, and wage dynamics. A lower than expected unemployment rate is generally bullish for Japanese yen as it reflects a tight labor market, stable income conditions, and improving domestic demand. This often puts downward pressure on USDJPY currency pair. A higher than expected reading signals labor market weakness, reduces confidence and economic momentum, and typically weighed on JPY, pushing USD JPY higher. Although Japan's unemployment rate tends to be relatively stable, even small deviations from expectations can influence Bank of Japan's policy expectations and trigger short-term volatility in USD JPY currency pair. Now, let's take a look at the event details. Uh, the date and time is December 25 at 11:30 p.m. UTC time. The previous number we got was 2.6% unemployment figure. The forecast is also 2.6%. The actual data not yet released. It is going to be released on December 25th. Japan's labor market has remained historically tight, supported by structural labor shortages, an aging population, stable corporate hiring practices, gradual wage growth. With both the previous and forecast readings at 2.6%, forex markets expect a steady outcome, indicating continued labor market stability. However, traders remain attentive because any shift could affect expectations around wage driven inflation and future Bank of Japan normalization steps. Given USDJPY's sensitivity to interest rate differentials, even modest surprises in Japanese labor data can influence near term price action. Now, the recent economic trends indicated in Japan is that moderate wage increases in select sectors, stable employment conditions despite global slowdown risk, ongoing focus on sustainable inflation by the Bank of Japan, cautious policy communication from Japanese officials. A stable unemployment rate would reinforce the view that Japan's economy remains supported domestically, while any unexpected rise could raise concerns about slowing demand. Now, let's take a look at this scenario. Let's say a lower than expected unemployment number, and we get a number that is below than 2.6%. That signals a tighter labor market, support wage growth, and inflation prospects. That's bullish for Japanese yen currency pair, and the USDJPY likely moves lower. Now, if you take a look at a price chart, I'm going to show you the USDJPY currency pair, USDJPY over here. So if you take a look at a price chart, the daily chart, the USDJPY, it's already going down. We might find some support over here, but on an intraday basis, in 4 hour and even in 1 hour, the USDJPY currency pair is actually going down over here. Okay, so let's say we get a forecast that is 2.6% unemployment rate. That confirms labor market stability, aligns with current Bank of Japan outlook, and we are probably going to get limited volatility, and USDJPY may trade sideways. Well, it's already looking sideways in daily time frame. If check out the weekly, it's still kind of a sideways price action going on. This is the weekly chart, so price rallied up, then we got the drop, then it rallied up, then it's probably going to drop again. Okay. So with the unemployment rate expected to remain unchanged at 2.6% in Japan, the base case points to labor market stability in Japan. A steady reading would likely result in limited USD/JPY movement. However, any surprise deviation could shift expectations for wage growth and Bank of Japan policy, leading to increased volatility. The final key takeaway is Japan's unemployment rate release is a stability focused event, but surprises still matter. A lower reading supports JPY strength and pressures USD JPY lower, while a higher reading weakens JPY and lifts USD JPY currency pair. So, Forex traders should be prepared for potentially exaggerated moves due to holiday thinned liquidity and closely monitor how the actual figure compares with the 2.6% forecast number. Let us take a look at current week global market trends. I'm going to take a look at euro dollar and US dollar JPY currency pair. So regarding the Euro USD currency pair, which I already discussed, it looks a bit bullish over here, and we might get further upside in Euro USD currency pair. Regarding the US dollar JPY currency pair, it looks a bit sideways on weekly time frame over here. Market is trying to move in a trading range over here. This is the upper range and is the downside range. So market is moving in between the support and resistance level over here. Okay, and if you take a look at the smaller time frame, like a 1 hour chart, it looks bearish. Market is trying to drop over here in US dollar versus Japanese yen currency pair. Next, let us take a look at US dollar versus Canadian dollar. Regarding the US dollar versus CAD currency pair, USD CAD is going down. We got this nice bullish trend channel. This was a break to the downside, then a retest, and then market started the decline. The way I see USD CAD is probably going to drop even further. It's not going to stop. Expect further weakness in price action of USD JPY currency pair. So a good idea is to wait for a pullback and then look for a potential sell trade set up somewhere over here in USD versus Canadian dollar currency pair. Next one is the spot gold. Spot gold is going up. If you take a look over here, this looks quite bullish over here. The weekly trend is nicely up over here. The daily trend, we got this break to the downside, but after that market moved a bit sideways and then rallied back up even further. So we got a nice uptrend going on inside spot gold, and the way I see market is probably going to rise up over here. This is a bullish trend going on in spot gold. Okay, nice uptrend. Even if you take a look at a 4-hour chart, same story, looks bullish. Okay. Okay, if you guys have any questions or comments, feel free to type inside the chat box, and I will be happy to answer your questions. So what we have learned today? Well, we discussed about the gross domestic product related to Canada, and we also discussed about unemployment rate in Japan. And these are the assets: euro, dollar, US dollar, JPY, USDCAD, and spot gold. These are the assets to watch out for profits. What you should do next? Well, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. If you want to learn more about trading, visit TradeGeek and access free trading courses for beginner, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, December 30th at 2025 at 12 p.m. UTC time. So that's pretty much it for the time being from my side. Have a nice day and bye bye.